We are recording, so if you are a member of the 10th house, you'll get an email from us inside of Circle with a link to the replay, and then if you're not, you'll get an email as well by the end of this week. We're going to cover a lot today, a lot of really amazing things. So if you're thinking to yourself, Becca and Pauline said something that I'm, really wish I would have written down and I didn't, don't worry, you'll have access to the replay. Before I do some intros, I just want to take a look at where you all are joining us from. We have LA, Austin, DC, multiple from DC, Chicago. I'll be out in Chicago in a couple of weeks. We've got Brooklyn, Austin, Boulder, Colorado, my neighbor, lots of NYC, Denver. Oh, we do have Denver in the house. Hi, Laura. And we've got the Bay Area of Ireland. Beautiful. I lived in, well, if you call it lived, I lived in Ireland for 2 months, 2 or 3 months, and it was absolutely beautiful. Okay, welcome everyone. I want to do some intros just to let you all know who we are, because as I said, many of you are new here. This may be your first ever event with Female Founder Collective or the 10th House. And just so you all know, Female Founder Collective has a private membership community, which is called the 10th House, and that's where we host events like this. And if you want access to more virtual events, we also have in-person events and different markets around the US. And then we also have chapters throughout the globe that are geared towards networking and education. And then we also have membership opportunities and mentorship opportunities rather for members. So if you're someone specifically within the fashion and accessories industry, we are welcoming our fashion and accessories cohort in a couple of weeks. Right now, we have a wait list open. If you're interested in joining the wait list, you can go to the 10th House website. The actual application opens on July 25th. And Female Founder Collective, they have the 10th House, but we also have programming that we want to open up to the public, because we think, and a part of our mission is to give educational opportunities and resources to people who want to move the needle within their business. And we want to see more women do that. And within that, we partner with amazing organizations like Settle. And Female Founder Collective is thrilled to partner with Settle to further elevate female founders. This is part 2 of a 3-part financial fluency workshop series. We also have some downloads that we're going to give you all access to. This fall, September, I believe, we're doing a Black Friday prep for CPG brands workshop. So I know that's something that we're already getting a ton of questions about inside of the community. So if you're someone who's thinking to yourself, I haven't created my Black Friday or Cyber Monday marketing plan or financial plan yet, please join us in September. We would love to see you all there. And then I want you all to know that today is a workshop. So we're going to be presenting blueprints and frameworks to you, but it's also a time for you to get personalized feedback about your brands or about how to implement this information within your business. So utilize the chat, place as many questions as you have inside of there. Becca and Pauline will be taking them throughout. I'll also be placing links inside of the chat. So if Becca or Pauline mention something, I'll do my best to keep track of those and pop those inside of the chat, so they can really focus on their time with you and chatting with you today. But thank you all for being here. I'm going to pass it over to Becca and Pauline to officially kick us off.
Thanks, Avery. Excited to be with you all today. And I know we have a lot of content and a lot of good information to go through. So we're just going to hop right into introductions. I'm Becca Campbell. I am the head of customer success and operations at Settle, which we'll talk a little bit about in a couple slides. And mostly, I just want to introduce Pauline here, who is a wealth of knowledge, both as a founder herself, as well as a pretty extensive background, I should say, in finance kind of generally. Pauline, if you want to do an introduction, we do have another slide. We do have another slide 2 slides away to talk a little bit about Mocktail Club as well, but would love to do a quick introduction too.
Sure. Thank you so much for the invite. Really excited to be here and answer as many questions as I can. My name is Pauline Idoho. I'm the founder of Mocktail Club, which is a line of non-alcoholic cocktails inspired by travel. Prior to starting Mocktail Club, I spent about 15 years in investment banking, M&A, and a lot of finance roles. And the reason I started, because when I was pregnant, I realized there were limited options for people who aren't drinking. And that's how I started this journey of creating better for you non-alcoholic options. I'm happy to tell you more later.
Awesome. Thanks, Pauline. And you'll all have to bear with me. We use Google Meet, so I'm a little bit of a student myself here with the Zoom setup. So let's talk a little bit about what we will cover today. We are going to do jump right into non-dilutive financing to talk a little bit about what that looks like, as well as these funding options, what they look like in real world scenarios. Some funding considerations to think through as you are considering any one of these financing options, as well as some information on what else to consider. And then we'll have our closing as well. So we did our initial introductions. I'm going to turn it back over to you, Pauline, though, to talk a little bit about Mocktail Club.
Sure. So the concept started, again, I was in finance for 15 years and just realized that I couldn't be included in the party. I was actually celebrating a deal and realized that, you know, I had to make the bartenders make me this special cocktail that didn't have alcohol. And realized there was really this white space. One of the things that we do, interestingly, is we are inspired by travel. I'm originally from Nigeria, I grew up in London. I'm in France right now. And so leaned into working at the World Bank and doing a lot of global travel to create each flavor as a destination. So you'll see Havana Twist, Capri Spritz, Bombay Fire. We just launched Bali Breeze, which is, again, this sort of great vacation level drink. One thing that we also do is we bring in shrubs, which are apple cider vinegar based. So they have prebiotics, they're good for you. We also use antioxidants, so pomegranate juice, blackberry juice as well. So not only is it a great alternative to alcohol, it's actually better for you as well. And 1% of our sales goes to Clean Water Access globally. I launched, and I would say we launched at Whole Foods and a couple of sort of chef-related hotels and restaurants. And the market was a little nascent, and it's just started to grow. So we've kind of seen this really growth spurt in the market where people are looking to moderate, actually. A key driver, actually 94% of the people buying non-alcoholic cocktails are still drinking sometimes full strength alcohol, but looking to really cut down. Maybe it's Tuesdays to Thursdays. And that's really driven the category, and it's really also driven our sales and our growth in this category. And so we moved sort of from the Whole Foods to ultimately Target, which was one of our largest retailers. And that's been exciting to kind of grow. And I'm sure we'll talk about how to finance and how to move from bootstrapping, which I did for a number of years, from my savings from finance for a while. And then got to a point where I had to get more financing, which is where settle and equity as well comes in. And sort of how I've seen the interplay of, you know, how do you support expanding into stores, working capital, versus how do you support marketing to really build your brand and being able to sort of use equity for certain things and the ability to use debt for other things to really continue to grow, use capital and cash to expand.
Pauline, thank you so much. And I just want to highlight too for all of our attendees how delicious the product is and how you really have been able to bottle a destination in this experience too. A Capri Spritz is absolutely wonderful, and you feel like you're sitting on a beach, but also just really wonderful, like you said, for even elevating the everyday, right? If you don't want to go for that glass of wine, if you don't want to go for a cocktail, it's really wonderful to be able to finish your Monday or finish your Tuesday with one of these delicious beverages. Okay, so for myself, so I am with Settle. Pauline talked a little bit about us, but we do a range of things. We offer our working capital financing. We have a tech platform that our customers use for managing their bill payments, managing their POs, their inventory, cash flow, and forecasting. And I have been with Settle for a little over 2 years, working directly with our customers, wonderful brands like Pauline and Mocktail Club, helping them get access to capital for inventory purchases, for new opportunities that come up, whether that's in R&D and marketing, or to work with new retailers, or to pursue new partnerships. So excited to chat with you all today about the kind of financing, a little bit about the financing that Settle is most well known for, as well as just some of the other types of financing that are out there. And to kick us off, we have a little bit of a survey to just understand sort of where where all of our attendees are at. And our first question is just the number and types of financing that you all have leveraged in your brand journey. That is everything from bootstrapping financing coming directly from you, to having some equity, to having a line of credit, etc. Curious how many types of different financing we have out there. All right, looks like a lot of our attendees are in that 1 to 3 range. That makes sense. We saw the questions that were coming in when you all signed up. So it did look like there were a lot of questions for the type of financing that we'll talk through. And this will be helpful too for some of the other financing options that we want to share with you today. But let's talk about non-dilutive financing. What is it? So it's basically allows a brand founder to raise capital without giving up equity and diluting their ownership stake in the company. So anything that is direct financing or direct funding, we'll talk a little bit about examples in just a minute. When do you use it? I mean, you can use it at any time in your customer journey. It can be for marketing spend, for campaigns, for inventory, for expansion, R&D, new partnerships. We've seen our inventory financing at Settle used in a number of different ways. And this is a little bit based on the factors to consider when leveraging this kind of financing. So you're thinking, what does your cash flow look like? What is the speed of funding? What's the amount of funding that you're looking for, as well as some of the regulatory requirements? Looks like, all right, we've got about 91% of our attendees have had 1 to 3 different types of funding sources. So let's hop into some of the differences. I want to talk through the difference between debt capital and equity capital. So when you're thinking about something like Settle, like inventory non-dilutive financing, debt capital allows you to maintain 100% ownership of your brand and your company. You retain full control over the operations. There isn't a push on the lender side to be involved in the day-to-day or the operational management of the company. It's typically less expensive, and it's repaid at agreed upon terms. There are also no future obligations. So if you have debt capital for a dedicated period, you have that debt capital for that period. There isn't something that comes along 3 to 5 years later in which you have that future obligation. Interest is often tax deductible, and the qualifications for debt capital are typically based on business financials. So we're looking at your POs, your purchases, your projections, kind of how you're thinking about your business, new partnerships that you're talking to, new POs that you're getting. This versus equity capital. So you'll have some ownership dilution with equity capital. That's because you're giving away part of the business in order to get those funds, whether that's through stock or through other means. Essentially, you're giving up some element of the business in order to get those funds in the door. Investors can also sometimes influence the company's strategic direction. It's typically one of the things that we hear at Settle from our customers about the biggest reason that they don't want to go after equity capital, in that they don't want to lose control of the company's strategic direction. That's not going to be specific to all equity capital partners, but it's certainly one of the things that we see where there's more participation and influence in questions in strategic direction, et cetera. The cost of equity on this one is typically higher, and we'll have a slide to kind of walk you through what that looks like in a few slides here. And there is often no fixed timeline. There's also no obligation to pay the returns, which is certainly a little bit more flexible than your debt capital. And then the qualifications are typically based on business potential as well as the owner's character, which is something you don't always see in debt capital. Let's talk a little bit about the types of debt capital that are out there. So like I said, at Settle, we have invoice financing. This is where the outstanding invoices are used as collateral to receive that cash advance. This helps improve your cash flow while waiting for customers to pay the invoices. We'll talk a little bit about cash conversion cycle in another slide too. You'll also have lines of credit, so typical lines of credit that you see from a bank or a financial institution, things like term loans, which are also more traditional kind of bank loans, and then as well as asset-based lending, ABLs and MCAs, those merchant cash advances. Those are typically a bit more unique and have a slightly different structure than you'll usually see with lines of credit. But they can be based on and secured on things such as your inventory, your AR, or other company assets. And then with MCAs, you typically get like a lump sum of capital, and that's in exchange for a percentage of your future business sales. On the non-debt capital side, you'll see things like equity financing, which we'll talk about in another slide here, as well as things like crowdfunding, so raising small amounts of money from large number of people, as well as grants, which can typically come from business or from governments, local agencies. And these will sometimes help support specific project or business activities kind of generally. And then we have things that are seen maybe a little less often, but convertible notes, for example, as well as revenue-based financing. So investors provide capital in exchange for a percentage of the company's kind of future revenues until that predetermined amount is repaid. And I just want to take a moment here too to kind of ask you all, what are some of the types of funding that you all have used? I just pulled a couple out from our examples here, but would love to kind of hear for our participants which of those finance options you all have seen. And I think actually I may need to come to this survey a little bit later. Yeah, I can't launch it quite yet, but we'll find out in another slide or two. So based on all of these, actually, Pauline, maybe we can hop over to a question for you while we're working on this survey too. But would love to hear kind of what the Mocktail Club finance structure look like today. What is your debt stack, and how does that compare today versus potentially points earlier in your journey?
So initially we started off with pure equity. I bootstrapped initially, and then I did a friends and family round, which was actually a convert note. It was a small amount, and we did most of everything with that. I also got non-dilutive grants. So I did a lot with winning competitions and getting that non-dilutive money into the business. And then we got to a point where we needed like a lot more capital. And that was recent, actually. That's when we started with Settle. And even before then, we would sometimes do these sort of Shopify bridges or QuickBook bridges where, because they had access to your cash flows, they would be able to give you really small loans, but it was helpful. And it did actually help us at a point. But, you know, they were very expensive. So one, we wanted to reduce the amount we paid for our debt. And then we got, you know, over 700 plus stores and knew we had to put a lot of money into inventory. And we also raised equity, so it changed. And we actually did our first pre-seed round where we got investors into the company. But it was key for me that we weren't just using all the equity, which again is dilutive and it comes with a huge cost. Instead of using it for inventory, which sometimes you have to pay 8 weeks in advance and sort of manage payments to all the vendors. We wanted to make sure that we could use it for growth, for marketing, for branding, to really build out the Mocktail Club platform. So I think Settle is great, and that's where we are, where we have, a working capital to be able to expand into not only the stores we're in, but the future stores that we're growing into. And one thing that we've done really well is also manage our payment terms with all our suppliers. So there's probably only one vendor that we may do, we pay cash at the time of purchase, but typically we have at least 30-day terms with everyone. I mean, it took us years to build the credibility to do that, but between having 30 days to pay and sometimes having the retailers pay us in those 30 days, it enables us to use cash a lot better. So having a dedicated sort of Settle working capital loan and having those payment terms has really helped us to do a lot more.
Pauline, I think those are two great things that you called out there too. One, which I actually didn't even capture in our deck, is the way that you will want to use any one of these funding options for specific categories within your business. So even if you're potentially getting some of that equity funding, that you'd still want to have a financing solution to really manage for the inventory purchases. And then also just noting the kind of like variety of debt capital or financing that you've had over the years. I think that's pretty common, certainly something that we see pretty consistently with the CPG companies that we work with. And then the last thing that you noted too, with those terms with your vendors, absolutely, it's another great way to leverage financing to be able to either get the better rates or to be able to get better terms with your vendors. And that's another thing that we'll sometimes see customers come to us for, is the ability to pay their vendors sooner or faster to be able to get some of those discounted rates and better terms. I also figured out how to launch the survey, so would also love to hear from our attendees of these kind of like types of funding that we've called out, just a handful here. Has anyone gone after any one of these 4 different types of funding, from invoice financing, line of credits, crowdfunding to grants? I'm seeing quite a few people who have been able to leverage grants. That's really great. It was one of the questions actually that came up from a couple of the attendees when you were all signing up, wanting to understand a little bit more about the grant options that are out there too. All right, I'm going to end this poll and share the results with you all. It looks like the leader was really the grants, the next being line of credit, and then crowdfunding, as well as a few of you who have tried something like Settle with invoice financing. All right, let's hop into some of these funding options in real world scenarios. So similar to how Pauline has capitalized on a few different options across her business journey, a few things that we did want to note are the ways in which you can leverage these different types of financing, and even in some cases leverage them together, and what that can potentially look like for your business. So on this slide, what we did was call out the potential for revenue growth and what that ends up looking like across your blended cost of capital solutions. So we have the kind of keynote or the calculation down here for the specifics, but let's assume that we are a $5 million annual revenue company. We have 50% gross margins and $300K in equity cash to kind of play around with. In our first scenario here, we're using no debt, just building off of the cash from that equity. In this case, we're going to use 100%. And we can assume we'll see that 1.8 million in revenue growth. So that ends up coming out to a 40% blended cost of capital. Whereas let's say we use 50% debt utilization. So then we're only using 150K of the cash from equity and really starting to use some of that debt for inventory funding. We're at 50% now. That's when we start to see more like a 2.8 million for our revenue growth projections. And then our blended cost of capital comes down a little bit, but not too significantly, down to about 29%. Whereas in our last scenario, let's say we're using 100% debt, no cash from equity, 0% of that. Leveraging that really allows us to kind of supercharge that cash flow as well as that scale. And that's where we're seeing more like the 3.8 million, and your blended cost of capital is down to 18%. I could go into a whole slide and a whole presentation on blended cost of capital, but we won't get into that too much. It's a pretty hefty concept, but it's certainly one of the things that you want to keep in mind too as you are considering your financing options and potential lenders and the balance of debt to non-debt options that you are considering. So one of the things we talked about is a little bit about this cash flow gap and your cash flow conversion cycle for some of the businesses who are joining us today who have yet to feel this crunch, or maybe just starting to see the kind of like initial crunch that isn't too bad quite yet, as well as for those who have really experienced the crunch that comes with this kind of cash flow gap. Another way that you'll typically see this non-dilutive financing work best is in this scenario where you have this big cash flow gap. So you're seeing that, let's say we have that order come in June. We are paying our deposits for inventory as soon as, let's say, June 1st. That's our day zero. From there, we've got the shipment of goods, we've got customs and freight, and then we've got the prep for sales. That then turns us into essentially a 90-day cash conversion cycle where we've paid for all of this inventory up front, and we're not seeing any kind of revenue from our retailers really until that day 90 kind of kickoff point, all the way, let's say, through day 120. This isn't unique, certainly not unique with the customers that we're working with, and this will kind of overlap with your retailers and with any given PO. But it's a pretty good way of kind of understanding that your conversion cycle. And so a couple questions that we did see come in from the registrants was, why would I use a non-dilutive funding source? This is exactly kind of that scenario in which you would want to use it. Let's say you have your cash on hand, or let's say you've gone after those equity dollars. You want to keep pumping that back into the business. You want to spend that on R&D, on marketing, on expansion, and you want to be able to put a dedicated source of funding just straight towards this inventory purchasing. Because let's say day 90 rolls around and you got this massive order out to a retailer, and you get another massive order, you get another PO from another big retailer. You are in a bit of a crunch here because let's say your cash conversion cycle doesn't end until that day 120. So you're not seeing any cash come in really until the end of that gap. So now that we've talked through some of the potential pains there, one of the things that we also wanted to do is just put in share with you all some real world examples. So I've left this pretty anonymized with one of the other customers that we work with, and talked a little bit about their funding journey and how the funding sources kind of related to each stage of their journey. So in pre-launch, focus is really on product development, market research. So the two kind of main sources of funding they went after were grant funding, which sounds like many of you have already explored, as well as crowdfunding. So really going after those platforms that allow you to raise funds, build a community of early adopters, and kind of really validate that market demand. And then once we've gotten through that stage, in years 1 to 3, this is where they're really starting to build that credibility. They're expanding, they're adding new, in this case, they were adding new flavors, and they were pursuing new product lines as well. And for this stage, they were looking at competitions or awards, getting that cash, as well as the increased visibility through those award partners. And that's also the point when they started working with us as well. We were able to help them fund marketing campaigns, cash flow gaps, and really help them build that brand credibility. And then finally, in that expansion stage, pursuing those government subsidies and incentives as well. An interesting one that they had called out was the way that they were able to qualify for those local subsidies, which are really aimed at promoting local businesses as well as healthy eating initiatives. This was something that they mentioned they hadn't even thought about or wasn't on their radar, but was really specific to the kind of vertical that they were in with these healthy snacks. So whether it's government subsidies or funding options that you're looking at that are specific for small businesses, or they're specific to the vertical that you're within, these are it's certainly a great area to explore for the business. I would love to take a minute too and ask a couple questions for you, Pauline, and wondering, as you think about this, like the stages of your growth, and as you think about the different types of funding that you were able to go after, was there any point along this journey where you knew you had an opportunity, but maybe didn't have the cash to meet it, whether that was because it was tied up in inventory or tied up in other things?
Yeah, I would say once we started scaling in retail, cash became hard to have to pay everyone, and just feeling like you didn't have enough cash for the next couple of months to plan forward. So we've had that, and again, feeling like we're from just cash management ways of working with our suppliers, and doing a number of things to make sure that we have like 12 months or more of runway. We've sort of evolved from sort of day to day to really planning ahead 12 to 18 months and then forward. So it's been great to get to a point where you can sort of look big picture at what you're planning on doing and kind of even start doing 3 to 5 year type projections versus 6 months or a couple of months. So it's been great to kind of evolve. But yes, I think CPG can be very cash intensive, and ensuring that you want to get to opportunities is key, and making sure you have enough money to support it. And the tricky part is inventory is one thing, and then there's market and spend and everything else to really drive sales. So not only do you need enough for the inventory to get on the shelf, you need to make sure that you succeed on the shelf too. So those are the things we've dealt with.
Yeah, and I'm also just curious, one of the things that we sometimes see is that the brand founders we're working with, don't have that background in finance like you certainly do, and that sort of like business acumen, and the way you're talking about your cash flow projections for the next couple of years too. Was there anything else that you found particularly helpful as you were assessing the landscape? Were there groups, things like Female Founder Collective, certainly, were there other resource centers that you really tapped into in helping you kind of determine and with your your questions about this whole process?
Yes, there are a number of different accelerators. SKU's one. Pharrell Williams has this. It's a bit of a prize competition slash accelerator for Black and Brown founders, called Black Ambition as well. And there are so many for women, for minorities, for founders. And so it's not just the formal part. I think it's also the informal aspects of it, whether it's the WhatsApp group. I'm also a Tory Burch Fellow. And, there are 49 of us in this WhatsApp group. And I think there's a WhatsApp every single day, every couple of hours, where we just talk to each other. And again, one of the questions today was, how much equity do you give to employees? And so it's a lot of sort of crowd sourcing the answers from peers, from friends that have gone through a program with you. And typically out of those 49, let's use that Tory Burch group, out of those 49, there's one person that's already done it, or is bigger, or has raised, or has done something that you're planning on doing. So you get to learn lessons, which is always fun, of, what you should avoid. But I think these groups, these collectives, are super important because you get honest feedback on which accelerators make sense for you or your journey. And you're able to I'm sure I got settled from these groups. It's sort of that informal thing where people discuss what are they using, and then you get a couple of names and you do your own research. But typically that's kind of how I've come across things, besides kind of the formal finance that I used to have, but CPG is a very different ballgame. Even though I had a finance background, I still had to learn a lot about the beverage industry and retailers, which is very different.
Yeah, absolutely. One of the things that I've found so interesting in working with our customers is that it is such a different model of financial kind of entities that are out there that you can work with. And a couple of the ones that you had mentioned early on in the presentation, and you just realizing that they were, more expensive and or more complicated. That's certainly one of the things that we've seen is just, anyone who doesn't come from a background of finance or maybe who hasn't owned a business before, you might expect the landscape to look, not too dissimilar from what you have as an individual, whether that's a credit card or a mortgage or like a line of credit, and the structures and then the associated costs with each of these on the business side tend to be just much more complex, and being able to, drill down to the costs and the benefits and sort of like how much you would need potentially for each one of those, I know can be pretty complex. And I think all of the resources that you mentioned are just great places to go to help both in like the decision making of figuring out which of those solutions is best, as well as the potential costs associated with them too.
So there was this really great question that I want to answer of what I would do differently.
Oh yeah.
In terms of funding and launching, I think this is a great question. The initial person was going to say nothing, and I'll say why. I think everyone's journey is so different, and everyone does things differently. As in, someone could raise in a year and be a mega success. And some people take 5 to 6 years, and each individual journey, you learn a lot during that process at your own time. So I kind of love the journey that I've been on. I've met a lot of great people, done a lot of fun things. So I wouldn't change that part, but I would say on sort of the funding side, be careful about dilution. It doesn't matter as much today, but it does eventually. If you continue to raise, it does eventually. So be greedy with your equity, and that would be my sort of thought process and advice. Even if it's an accelerator or it's equity and it's pricing, really do the questions of what is it worth today. Try to surround yourself with people who have those answers, even if you don't, so you don't give up too much too quickly. So that's the one thing that I would definitely advise anybody as they think through funding sources. And it's perfectly fine. I'm glad we raised and we have equity. But just be aware of what you're doing and why, and what you're giving up and what are you getting for it. It's a transaction, but you need to be getting your value off whatever you're doing. So highly encourage you. And again, it's tough when you're a founder, you need equity or you need something, and someone saying they have the answers to kind of just say yes. But just think through it a bit and try to get as much advice and as many founders or people who know how to navigate and get their opinions.
That's such a great point, Pauline, and so great for organizations like Avery with the Female Founder Collective too, being able to help small business owners and founders really kind of work through those options. You said be greedy with your equity, and I think that's maybe the quote of the day. I love it. I am going to use that with their customers too, who are balancing this very question of like, why wouldn't I go after equity? It makes so much sense. It's such easy funding. And I think part of that is just the ease of seeing the opportunity with the capital, the potential for the cost savings, et cetera, but really being able to balance that against all of the other non-dilutive funding options that are out there, as well as the ROI, I think, in making that determination. And I think that was a great opportunity too to talk through a little bit about the working capital solution landscape that's out there. So if we're not going to do equity, if we're going to go after this non-dilutive financing channel, kind of what are we looking at for our potential options? So on the Settle side, we have invoice-based financing, like I shared early on, in that we are underwriting and we are approving credit profiles, limits, and our customers kind of, you can think of it like a line of credit based on their business projections, based on various components of the business, especially important for those companies that are just starting to make revenue, maybe not even profitable quite yet, but are seeing that on the horizon. One of the questions that did come in from our registrants was, sort of, what do I need to have in place? Or do I have to have orders? Do I need to have POs specifically before pursuing any one of these options? And I just wanted to note that it's pretty flexible. So depending on the solution that you are after, there isn't, especially with these kinds of solutions, there isn't always a requirement for the kind of profitability that the kind of like initial profitability as well as ongoing profitability that you might find with other providers. So with Settle, for example, you're seeing what our APR is, what the timing looks like, the ease of the process, the ability to turn around a kind of credit profile to our customers right away. Then we have a couple that we talked about as well, the MCAs and then the revenue-based financing. Those can be on the pricier side in terms of timing. They're pretty quick to turn around. I think if you Google any one of these, I think the headline that you'll see is that like speed to funding. All of them work really quickly, knowing that the businesses that we work with are also working on very fast timelines. Ease of process is a little bit easier to medium in that there are other considerations involved as well, things like your future revenue, et cetera. And then the repayment terms are a bit less flexible, and the transparency is definitely something to call out, and a bit more complex, not always clear to determine exactly what your APR is. On the bank side, this is almost always going to be your cheapest option. The difficulty there is that there are pretty high bars to qualifying. The timing is typically much slower. The ease of the process, we say it's difficult to impossible. It's possible. It's just very difficult and complex. You oftentimes have to provide quite a bit of paperwork and resources kind of beyond what you might see in either of the two other funding options. The repayment terms aren't typically flexible. You're looking at very discrete and very specific repayment terms, repayment dates, and there's not a lot of flexibility in deferring those payments. Whereas a partner like Settle, for example, or some of these others, there's flexibility if you know that that repayment date is coming up and you need the flexibility to pay it back because you have, maybe your main retailer isn't paying you for another 30 days or it's been delayed. There's some retailers that our customers work with who are just notorious for being quite late on their repayments. You won't see the kind of flexibility with a traditional bank. And the transparency is pretty simple, but it is that long process. So again, it's balancing all of these pros and cons for the given time of your business growth, as well as the what you're looking to fund as well. And then for just another kind of real world example in diving into the funding sources that you might go after alongside your customer or your business journey. Pre-launch, this customer, they are one of our hair product customers, and their example was in the pre-launch stage. They went after an incubator, so they had a kind of novel and unique hair care product that was great for the type of incubator funding sources that were out there. The nice thing about the incubator is that included mentorship resources and really networking opportunities with other CPG companies, founders, et cetera. And then they also went after tax credits. So tax credits to really help offset the R&D of their product, which really freed up their capital for other pre-launch activities. On the early growth stages, those 1 to 3 years, that's when they started working with Settle. That allowed them to launch and to get new POs as they were going into Sephora and then Ulta after that. And it also allowed them to pursue strategic partnerships. So providing funding from those partners in exchange for exclusive product lines and co-branded products, they really found that as like a nice source of additional funding in those early years. And then lastly, they've moved into incorporating a subscription model as well. So because they had a product that was regularly purchased and just a really great customer base, they were able to leverage a subscription model that also helped them a little bit with that cash conversion cycle, bring in those funds along the way. I will say in their case, they're still at the 5-year mark and they're still working with us as well. And we sit alongside their subscription model. And another nice thing to call out about the subscription model is just the great resource and number of platforms that are out there that kind of help new businesses, especially launch into something like a subscription model. Pauline, for you, would love to talk a little bit about this journey. And I'm wondering if you all are prepping right now for the upcoming holiday season. Avery was talking about how they've got the Black Friday session coming up. This is a little bit of a peak period for us as well, because we just have customers coming to us for their Black Friday inventory purchasing, prepping for that holiday season. I myself am always shocked by how early those holiday decorations come out, let alone talking in July about holiday inventory purchasing, and also being on the heels of Prime Day, or being in the thick of Prime Day, I should say. Pauline, what about for you all? How are you thinking and planning for the rest of this year, early next year?
Yeah, so we, in the last year or two, have been very supply chain geeky, I guess. So we do about 4 production runs during the year, and I try to bundle everything. So it's extremely hard in the sense that we're trying to figure out how well are we going to do between Thanksgiving and then dry January is our Super Bowl. And really trying to come up with a forecast in order to produce enough. But what we've been able to get is a lot of savings of buying bulk. So a lot of what we try to do, from the can costs to other raw materials, is also get the economies of scales to reduce our cost of inventory buying as well. So that's some of the things we're doing to manage our cash and price ingredients best we can, with more buying power. But it's a bit challenging because we're sort of trying to forecast December, which is always hard. And we try our best not to run out of inventory on shelf, because that's, our suppliers hate to not have you be someone they can depend on. So we try to ensure we have just enough or a little bit more, so that we don't run into supply challenges at our retailers.
That's such a great point too. There are some retailers we know that even charge fees for those stockouts. So being well ahead of that, and or just knowing what those potential fees are as you're going into those partnerships discussions, super important. All right, we've got about 10 minutes left. We want to leave a little room for question and answer. And I see, I'm sort of catching up on the questions. I know that Courtney from our team is also helping answer some of those questions, but we did want to leave a couple minutes at the end too, to go through those questions. One of the other things that we wanted to talk through was kind of what else to consider. So let's say you're ready to go for these non-dilutive funding sources. You know, what are going to be some of the requirements? What are some of the things to keep in mind as you're pursuing those types of funding? And the main theme within this is to have your sort of basic business information pulled together, ready to go, and that you have some semblance of your tech stack that is able to show things like inventory, your POs, and or your accounts receivable. The couple things that we wanted to highlight are specific to Settle in that we have these bill pay tools and we have our PO tool as well. So it's not just something that we offer as a product suite, but it's also the kind of thing that we are looking at when we are assessing customers for underwriting. Everything from how they're managing their POs to the kind of volume of their POs. And the other element of this that we do want to call out is just another one of those great funding opportunities that you all should keep in mind too, is the ability to keep track of your POs, the terms that you set up with your vendor compared to what they are invoicing you for, compared to what you receive when that inventory comes in the door. We find this as one of those holes that our brand customers are constantly up against, or have historically been up against prior to working with Settle, where there isn't a one-to-one match between what they ordered on that PO compared to what their invoice for, compared to what they received. So another thing to keep in mind when you are taking a look at some of these funding sources and some of the asks that lenders such as Settle and others will have in that understanding, like what sort of business tools you're using today and how you're managing everything from your POs, et cetera. This is going to be another opportunity for just us to talk a little bit about on the tech tool side. So want to get a sense of, for our participants today, what's your approach to the tools that you all are leveraging, whether that's for managing your AR, whether that's for cash flow forecasting or for managing your POs. Just launched a question, a little survey here for how many of you are already using some tech tools to manage and track your inventory as one of those big sources of information for funding. It looks like we've got a little bit of back and forth between having a paid platform for inventory tracking to not using a tool today, to not using a tool today, looking for a tool. It looks like it's actually pretty evenly distributed between those three. Surprising, we have a lower number of participants who are using free tools. I would say that Google Suite, the Google Worksheets is one of those inventory tools that some of our new customers coming in have typically worked with. But it looks like, yeah, we had even distribution between the last three having the paid platform for tracking, not using a tool today, and then also being in the process of looking for a tool. So before we hop, just wanted to do a quick little parting thoughts slide here. First thing is to be prepared. It's never too early to put the tools in place that are going to help you kind of navigate this moment in your brand's life. So getting your tooling ready, really being prepared for the kinds of questions that any one of these lenders, particularly those that you're looking after that are non-equity based, getting your tech stack in place, making sure that you've got the process to manage your inventory, manage your AR, your AP, as well as your POs. And then another point that we didn't get a chance to talk to too much, but really lining up the financing so that you're ready for each stage of growth, as well as those stages of growth that you're not yet ready for. We regularly have customers that come to us that say, I just got this massive PO from Sephora. We need to move on financing. So thinking ahead and really thinking optimistically and dreaming big about the potential partners that you would have out there, and planning for needing to fill those inventory orders because they can come up really kind of at any time. And then working on your modeling too. So Pauline talked a little bit about this too, really forecasting and planning your inventory needs, whether that's the year out, the 3 years out, thinking about your growth along those lines. And lastly, you've got this. So we're here to help you. Female Founder Collective is here to help you. Seeing all of the comments in our thread too about folks who would love to connect, who'd love to work together. Know that you've got a great community, both within the founder space, within the financing space, and within partners like Female Founder Collective. Pauline, before we open it up for questions, and maybe I'll start diving through the chat too to see if there are any questions that we want to specifically address. Any other parting thoughts that you want to share with our attendees?
I love you've got this. I think that's true. And I think the most differentiated product that you can bring is something that comes from you, because you're such a different individual and you come with your own strengths. That's why all the flavors are inspired by travel, because that's my thread. And everyone has their unique thread, and you're no longer competing with other people because your vision is so different from the other person. So you've got this, lean in to yourself, to your unique strengths, and build that community of other friends, peers, advisors, and you'd be surprised how many people, without giving up any equity, are willing to help you through this journey, to give you great advice. So lean into that, to, you know, whatever holes you have, find people who can help you with those. That's all I have.
Awesome. Awesome. Thanks, Pauline. I was just going to, I'm taking a look through the chat and also just pulling up, so feel free to ask questions as you all have them, if you have any more. I was also pulling up some of the questions that we received when you all signed up, and we had one question come in: how do I get started? What are the requirements, eligibility, questions a lender are going to ask? How do I get started? Just great to have those conversations, like Pauline said, with your network, with fellow founders, to really understand what solutions they were looking at, and then just start having those conversations. So here at Settle, for example, we have a ton of prospective customers who have reached out to us at very early stages and are sort of like, I don't know that I'm there yet. I don't know that I qualify, but would love to get the conversation started. That said, a follow-up question was, what's the lead time for alternative funding? Like I mentioned in that slide, and yes, we'll share the slide deck around. I saw that come in as a question too. Like I shared in an earlier slide, it's typically pretty quick for the underwriting process, especially with alternative lenders and non-dilutive capital financing options like Settle, in that we can turn around answers pretty quickly and get you up and running on working capital pretty quickly, especially definitely well ahead of planning for those holiday seasons. If there is an alternative financing solution out there that takes a long time, I would be surprised. So you typically don't need a ton of lead time in getting access to funding. Let's see, what other questions do we have here? Payback terms, typical terms. We talk a little bit about that. There's a lot of flexibility, whether what the repayment structure looks like across the full amount of time. Typically, it's pretty closely tied to your cash conversion cycle, what we went through on an earlier slide, from the time that you're putting in the order with your suppliers to the time that you get the funds from your retailer, and then also the way that you're paying back, whether that's partial payments each of those 30 days, or whether it's a full lump sum payment at the end. There's a lot of flexibility. And I think those were all the questions that I see. Avery, I think we've covered everything, unless there's anything else that we can talk to.
No, I just want to echo what everyone is saying in the chat. This has been such a great discussion and such a great event. And thank you so much, Pauline. I know it's not always easy to share the ups and downs and challenges that you face as a founder, and you've done so beautifully today. So we really appreciate that. And Becca, you for guiding this discussion and really giving us some tangible insights as far as non-dilutive funding options. And as we all know, and as we've all seen today, Settle really levels the financing gap for women-owned businesses. And I've popped a link into the chat. You can ask us. I know Pauline shared her email. You can always email me directly at the email that sent you an invite for this event, and I can send you to any resource that I have. But if you're a brand like Soft Services or Dagny Dover or Gia, which are brands that Settle serves, then you may be someone who could leverage the platform as well. But like I said, this is part 2 of part 3. So we'll be seeing you in a couple of weeks for Black Friday and Cyber Monday discussions. I am here in the meantime. The replay will be available within the next 48 hours on our education page. And you should be receiving an email from us as well with a direct link to that. But thank you again, everyone who joined us live, everyone watching the replay as well, and to our amazing hosts.
Yes, massive thank you to Pauline and all of your insights today. Really appreciate it. And thank you to all of our attendees too. Really appreciate you all joining us.
Yes. Thank you for all the great questions. Thank you so much. It's great
Yes.
meeting you all virtually.
We'll see you
Bye.
soon. Centos members, I'll see you Thursday. Bye, everybody.
Bye, everyone.